Can start. Can start. You're on. Start.
Hello, our dear learners. Once again, you're most welcome for the tuitions for RCM publishers, which has a training program and also a lot of reading material for you. The session of the moment is about leases, which I have discussed before. So this is a lesson 2. This is I had introduced myself before. I'll do it again. My name is Gabriel Orina. I'm a financial reporting tutor and financial accounting. Welcome again. The topic of the moment is IFRS 16 leases. And straight away, for examination purposes, the aspects we are to cover is finance lease, which in our case I've already covered in these tuitions elsewhere. We have operating lease, we have a sale and leaseback. So 3 very important things: a finance lease, operating lease, a sale and leaseback. Once you have those, it means you can deal with an examination question in any form it is put. Already discussed this before. So today is about an operating lease. Perhaps just a recap about a finance lease. That it is a lease that transfers substantially all the risks and rewards of ownership of an asset to the lessee. Substantially all means most of the risks and rewards associated with this particular asset are transferred to the other party. That party may eventually either return the asset or own the asset, depending on the terms and depending on the payment of the lease rentals. That was about a finance lease. Then about an operating lease. The definition in the standard is that it is a lease other than a finance lease. A lease other than a finance lease, which means it does not transfer a substantial amount of rewards or a degree of rewards and risks to the other party. Now that brings it to being a rental or hiring agreement. And by so saying, we are making it be a short-term arrangement. That is an arrangement to control, use the property on a renewable basis, frequent renewal. Now then the next step is about an operating lease. The lessee acquires the right of use of this asset, makes continuous payments at regular intervals. The payments may be equal or they may not be equal, but they will be relatively continuous over the lease term. And often, this lease is renewable at the option of the person who is leasing it out, whom we call the lessor. Remember, we have the lessor, we have the lessee. The lessor is the owner of that property. The lessee is the person who hires the property, occupies or uses that particular property in return for payments, which we call rentals. So then, the next thing is about the accounting. In the books and accounts, of the lessor in the books and accounts of the person who owns that particular property. In an operating lease, the lessor retains most of the rights and also most of the risks to that particular asset, which literally means he has control, or she has control over how the lessee can use that particular asset. For example, the lessee cannot modify the asset because of the terms of that particular lease. Now, from an accounting point of view, how does the lessor account for that lease? So the asset, this person accounts for the asset as a non-current asset, which is called property, plant, and equipment. Why does the lessor do that? Because the lessor not only owns, but has control, has the ultimate control over that particular asset. So it's accounted for as property, plant, and equipment. Then another thing is the carrying amount. The carrying amount of this particular asset is the cost or fair value less accumulated depreciation or impairment loss. Impairment loss. That is about the asset. Now, regarding the income, the lease rentals. Lease rentals are accounted for as income. They are accounted for as income, and they are accounted for as income on straight line basis. What this means, if the lease is a 5-year lease and the lessee, okay, there is an agreement as to how the lease payments or the lease rentals will be made over the 5-year period. The amount is added up and then divided by the period of 5 years. That gives you equal amount of lease rentals per year. Then, regarding the lessee, that is about operating lease. We are on operating lease. Yes. The lessee is the person who hires, does not buy but hires that asset. Now, this person has got limited rights, both of use and maintenance and anything. Cannot sell that asset, for instance. The main interest of the lessee in this asset is defined by the usage and the payment of these rentals. So accounts for the lease rentals paid as an expense on a straight line basis. That means the amount which is payable over the term of the lease should be divided, or should be apportioned equally over all the years, each of the years of that particular lease. Now, such an expense then, of course, will appear in the statement of profit or loss. In the statement of financial position, only any accrued or prepaid lease rental is treated as an asset. So prepaid or accrued lease rentals are treated as asset or liability. There are situations when in the first year, the first year of the lease term, greater payments are done than what is done in year 2, year 3, and so on and so forth. There are also times when in the first year, the payments are lower, which leaves an accrual. The payments are lower, and then they increase with the future periods. Now that brings us to an example here. Okay, this is the example. We have receipts and payments recognized as income or expense in the following manner. This is the example. any case, operating leases will certainly produce short questions, and so that's why I've had to write it. So the first thing is that there is a lease of property from X to Y, and the lease is an operating lease. And this lease has a lease term of 5 years at an annual rate. That means the rental per year is 100,000. However, the contract states that the first 6 months are rent-free period. That must be from 1st January 2015 up to 30th June 2015 is a rent-free period. There will be no payment. The payments will come up in the future. So whereas in each year, payments are supposed to be done of 100,000, in the first year, the first 6 months we are exempted, so we'll be paying actually a total of 50,000. So now you're supposed to show the recognition and the reporting of the lease-related information. I'll start with this comment I made at the beginning, that the lease rentals are recognizable as an expense in each of the years of the term of the lease. How are they recognized as an expense? They are recognized on a uniform or equal basis, such that even if the installments fluctuate from 1 year to the next, such fluctuation does not affect the expense. It only affects the payments, but does not affect the amount of the expense, because the expense must be apportioned equally. Now this is it. Such a question can ask you for either journal entries, ledger accounts, and financial statements. So the first thing I'll do is to show you the steps. First, journal entries. That is, how are these amounts to be recorded? If I have to start from the journal. Okay, this is it. In journal entries, in the first year, the first thing that we recognize is the payments. Because of the half payment, the first payment will be the cash account, 50,000. But taking note that this is a duration of 5 years, the total amount which will be paid is going to be 100 times 5 less the rental for half a year, which is 50,000. So the total payment is going to work to 450,000. Now this 450,000 is the amount that will be divided uniformly. That amount will be divided uniformly over the period of 5 years. So 450,000 is the amount that will be paid across the 5 years, because the first 6 months 50,000 is not payable. And when I divide this by 5, I find each year the amount which accrues to each period is 90,000. Now when they pay 50,000 and the amount of expense is 90,000, that means there is an accrual. There's an accrual here. There's going to be an amount here which is going to be added, so as to make the amount to be, beg your pardon, there's going to be amount here of 50,000 plus 40,000. Now that makes a total. The cash payment is 50. The 40,000, this is in the books of LEC, not the lesser. The books of the LEC, that's how it works. We credit, accrued, rental. The accrued rental is 40,000. Now this is the expense. This is the rent expense. That will be 90,000. So what have we done? We have recorded how much was paid, the amount which is outstanding, and therefore the total amount which will go to the expense. That's 450,000 divided by 5 years. That's in the first year. Now in the second year, the amount expected to be paid, the amount paid rather, in the second year is 100,000, but the amount of expense is 90,000. Now that means as we go along from one period to the next, we start cutting down, we start reducing that accrual. The amount, the first accrual was 40,000, so the accrual will be reduced as we make payments. So the rent expense account remains 90. Yes, and the payment is 100,000. So there is a 10,000 that we are going to reduce from this liability of 40,000 that we incurred in the first year because of the underpayment. So this is your debit, accrued rental. Then the credit entry is the payment, cash account, because we paid 100,000. Yes, that gives you the pace of payment and what? And recognition of the expense. The same thing will happen in the next year. So this is the first year, second year, third year. The rent expense remains the same, 90,000, and we keep reducing the accrual. So accrued rent or rental, we reduce it by 10,000 through a payment of 100,000. Now, if I was to go to the next year, I will do a repeat of the same. Let's then get to what the question requires here. The question requires to show the recognition and reporting. Now, the recognition is already done here. This is the recognition, how you recognize this as an expense, as a liability. Next is what follows. What follows after these entries is how do we recognize this as an expense, an asset, or liability. So we have here Y limited. That is the receipt. The statement of profit or loss. The statement of profit or loss, we shall have expenses. The lease rental, we said is going to be uniformly 90,000. So this is going to be in year 1. In year 2, the lease rentals will be 90. In year 3, So what comes out is this. We have 1, 2, 3, 4, 5. The amount here, we have here 450,000. Remember the first 6 months was exempted. So in the first year it was 50. Then the next 4 years, 100 times 4, that is 400, plus 50, that is 450. But then that amount was divided or apportioned equally. So this is the kind of statement of profit or loss you get. Yes? Lastly, we have the statement of financial position. Go up to 2019 because the question asks for 5 years. 5 years. Yes, there we are. Now, in the statement of financial position, we are in the books of the accounts of Y Limited, not in the accounts of X but Y Limited, which is the lessee. Remember, the interest of the lessee was just the usage of the asset but not ownership. So we do not have any non-current asset here. We have under current liabilities. Yes, under the current liabilities, we have the accrued rentals. That is, amounts which ought to have been paid have not been settled. From the word go, we had a difference of 10,000 per year, and in total, out of 450,000, in the first year we paid 50,000, and we're left with 40,000. That is the accrued amount. This accrued amount will continue to decline, to reduce. We have 20, we have 10, and we have none. That is, the total amount of 40 is reduced by 10,000. That is as it accrues. Yeah? As we release this to expense, release 10,000 to expense every year. So we get that pattern. Now that does it for us as far as operating leases are concerned. Yes, as far as leases are concerned, you'll get more exercises after this session. You'll be able to get more exercises to practice. I want to turn over to a sale and leaseback. That is a sale and leaseback. What comes to mind when we talk of a sale, we mean the transfer of ownership of a property to another party, that is, the other party acquires title to the property. When you talk of a lease, we're talking about transfer of the rights of use only, the rights of use of that particular asset. So now there are two transactions packaged in one. Somebody sells the property and again leases it back. Both of them are part of the same transaction. So the original owner of the seller finally becomes the lessee and the buyer becomes the lessor, such that the seller of the property continues enjoying the same benefits it was enjoying before regarding the use of that particular asset. This then can lead to either a finance lease or it can lead to an operating lease, depending on the agreement. Now, if it leads to what it leads to either a finance lease, then it's a form of loan. And not a sale. Because someone is going to use that asset as a security for payments, for continuous payments. So in that case, it's not a sale, it's a form of loan or lending arrangement, long-term lending arrangement. It can be an operating lease. That is, after the sale, then the lease back. The buyer of that asset leases back, but on an operating lease. So the ownership is completely transferred. So in this case, it's a normal sale. Then operating lease. So there is a normal sale in these circumstances. So then let's try to account for the finance, the sale and finance lease first. As I said, in this case, there's no outright sale. There is a form of lending arrangement. And I have a question. This question, I'll have to talk to my crew about how it will be delivered.
Discussion. You can send it
later. Okay, so the question will be made available, but this is what it is. It goes Mbegu Limited. Made a sale and finance leaseback on 1st April, that is 2017. Yeah, so what it sold, this is a machine the carrying amount was 3 million shillings for a price of 4 million. Price of 4 million and leased it back. The asset was leased back. The asset was leased back over a 5-year period. This period, we are told, is equivalent to its estimated useful life. When the term useful life is applied, it means this is a finance lease. So then, we're told the finance lease provides for 5 annual payments in arrears. So, terms of lease provided for payments of 900,000 shillings. Annual payments. This is annually. And the rate of interest which was implicit in the lease was 5%. There is a question. Mbegu Limited makes a sale and a finance leaseback. Sale and finance leaseback, date 1st April. The machine is sold at a carrying, it has a carrying amount. That is the book value of 3 million for a price of 4 million. So there's a difference here between the sale price and the original carrying amount, and leases it back over a 5-year period, equivalent to its estimated useful life. This statement here tells you that this is a finance lease. Terms of the lease provides for payments of 900,000 in arrears annually, and the rate of interest in place in the lease is 5%. So then, how do we account for this in the books of the seller? So here we're talking about recognition and the reporting. In the accounts of Mbegu Limited, take note that Mbegu Limited is the seller who also became the DC in that asset. So step 1, supposing that everyone has understood that first step, we have 2 things to calculate. The first one is the sale itself, and then the next one is the lease. So here, in our answer, we have workings. The first working is the recognition of the sale of this asset. This took place on 1st April 2017. So 1st April 2017, the sale price was 4 million. And the carrying amount is 3 million. Now what happens, as I said earlier, in a finance lease, it's not a sale as such. The one that is a sale is the operating. If there is a sale and operating lease, then there is a complete sale. But if it's a sale and finance lease, the two parties are still tied to one another. There is no discharge of a complete sale. So this 1 million is in effect profit that will be recognized by the seller over a period of 5 years. So then the profit, this is the year ended. The first year ends 31st March 2018. The profit will be that is 1 million over the 5 years, that is 200,000. Then the year ended 31st March 2019. The profit will be the same. 31st March 2020. We started from 2017-2018. The amount of profit will be 200,000. So what we do is we allocate that particular profit of 1 million, we allocate it equally over the term of that lease. Okay, that's one thing that has to be calculated. The other thing to calculate is the lease liability. So working number 2, calculation of lease liability or liabilities. When we acquired this asset on a finance lease, rather when we sold and acquired on a finance lease, 2 liabilities come up. Which are these 2 liabilities? One is there is this profit here, which is deferred. See, out of 1 million, we recognized in the first year a profit of only 200,000. So what we have done is to defer a profit of 800,000. Now that deferred profit is itself treated as a liability. Another liability is the amount which has not been paid. Okay, so the first one is deferred income. The deferred income. So here, total assumed income $1 million. So year 1 income is 1 million shillings over 5 years. So the amount of income or profit we recognize here is 200,000. We recognize 200,000 of this income of 1 million. We recognize 200,000 for the first year. Then we are left with this at the end of the first year is called the deferred income. The deferred income. Then in year 2, the income, recognizable is 200,000. So the deferred income Yes, the deferred income is 600,000. I need to go to the third year. So the income recognized is 200. Then you have 400 deferred income. So the point is that income recognizable is the amount you include in profit and loss. The amount which is deferred income, you cover it under liabilities. Now, which liability? It will be divided between the non-current and current liabilities. So that is one area of liability to do with deferred income. If I proceeded to year 3, I would recognize 200,000 and then reduce this again by 200,000, and this will reduce until the balance of deferred income will be nil. Okay, let me then proceed to the lease liability, the liability on the lease. So this is about, we're calculating the lease liability and deferred income. Yes, two things. So the liability in the first year, the amount, the agreed value, that is the cash price of that lease, the cash price of this lease is 4 million. What does this stand for? The agreed price that will have to be paid, the amount that will have to be paid, whether by installments or by what means, and on which interest will be calculated if it's not paid. Then interest charge or finance cost, because the company, Mbegu Limited, is the one going to pay the interest. So this is going to be an expense, and that is at 5%. So 5% of this will be 200,000. So we are adding interest to the principal amount here of 4 million to get the total amount payable, and then the installment paid, the rental paid. We informed 900,000 is paid in each year. So we're saying 4.2 million and 900, so 3.3 million. Now that stands for the outstanding balance at the end of that year. So balance 31st, okay, it was March 2018 at the end of the first year. Then in the year 2, this was year 1. In the year 2, interest charge at 5%. Now the 3.3 million will accumulate interest of 165,000, 5% of it, of the 3.3 million. then the rental paid maybe our dear runners could be moving a little bit fast. This is what just said. The cash price is the full amount payable before the interest is charged. The interest is charged as the obligation remains unsettled. So this interest accrues because the obligation is not settled till the end of the year. The rental is paid at the end of the year after the interest is accrued. This is the balance that is carried forward. In the next year, therefore, we charge interest on the 3.3 million, and the rental paid is a constant 900,000. So the balance on 31st March 2019 is 2,565,000. Yes, you can see what will happen in the next year. 5% will be calculated on that, on the basis of that asset there. So year 3, the interest charge that's 128, 250. $128, 150. Yes, we've gone so far as identifying the liabilities, identifying the relevant expenses in each case. So what I wish to do next is to prepare the financial statements. Is the last bit of it. Yes. So I'm going to take first 3 years. This is 20, let's say 2018. That is, what incomes and what expenses do we put here? Incomes. This is profit. Is that profit on the sale of that property that we apportioned to 200. Yes, it continues up to where the lease will end. Presumably that is 2020. 22. So that is the income aspect. Then we have the expenses aspect. Expenses. There are two things here. We have the interest factor. Yeah, we have the interest factor. We have, this is the profit on the sale of that asset. And remember how the profit was apportioned. The total amount of profit was supposed to be 1 million. It has been apportioned that way on the sale. Then on the expenses side, we have the finance cost or interest. I could put depreciation first because I'm operating expense. So depreciation expense, considering that the asset has a value of 4 million and it's going to last a period of 5 years. So the amount of depreciation will be 800,000. Yes, to 4 million over a duration of 5 years. Then we have the interest charge or finance costs. That is the amount of interest that is charged in the first year. 5% of 4 million was 200,000. The second year, it's not uniform, it's 165. The third year, the amount of interest charged is 128,250. Yes, goes on that way the next year, because we will see the trend. Now, the very last thing is how do we do a statement of financial position? First, a statement of financial position simply is about assets and liabilities. Okay, this statement will have the non-current assets, so we shall have property. One will have to write it in full, but the way I'm writing it is in short: property, plant, and equipment. Now, the property, plant, equipment, remember we are in the books of the user or the lessee who has acquired this asset at 4 million. This has nothing to do with the installments or interest. The 4 million is the cost of that asset. Then the 200,000 every year, we have 200,000, that is the depreciation. We have it here, depreciation, rather 800,000 for depreciation. So 4 million less 800,000 is 3.2 million. So at the end of the first year, it's worth 3.2 million, or estimated to be worth 3.2 million. Now 3.2 million is the carrying amount at the end of the first year. The next year, it drops by a uniform amount. We are using the straight line basis. So less 800,000, that's 2.4 million. Then less again 800, that is 1.6 million. Yes, that is how you report a non-current asset in this case. Then we have non-current liabilities. These are long-term financial obligations. Now that means at the end of each year, we have, this is finance, lease, obligation. Then under the current liabilities, we also have finance, lease obligation. So that particular liability that we have at the end of the first period, this liability we have at the end of the first period is going to break down into two liabilities. This figure, I repeat, is going to break down into two liabilities, in the sense that the amount will not be payable in future at once. It will be payable continuously. Therefore, a portion of it will be paid in the next year, and a portion will be paid well beyond that next year. Now, how much then out of 3.3 million will not be settled in the next year? That is year 2. It is this liability here that goes beyond year 2. The liability that goes beyond year 2 becomes a non-current liability at the end of year 1. So we have 2,565,000. That becomes the finance lease obligation that will roll over beyond 2 years. Then that means if I take the liability of 3.3 million and I less this amount here, I'll get the current liability. So 3,300 less 2,565. So I have 735,000. 735,000, which is an obligation that will have to be settled out of the total of 3.3 million. This amount will have to be settled in the next year. This will be settled beyond the next year. Then when we go to the next period, okay, the question was short. It was meant to be just for 1 year. But if you go to the next period, at the end of the next period, we have a balance of 2,565. A balance of 2,565. A portion of it will be paid. A portion of it will be paid in the next period, and some of it will have to roll over to another period. So this is it. The balance at the end of year 3 becomes the non-current liability, 1,793, 250 becomes the non-current liability. Then the current liability becomes a difference between 2,565 and 1,793. That is 771, 750. I repeat, we have 2,565 less the amount that will be paid of 1,793, paid after 2 years. We're left with 771, 750. What you can notice is that the non-current liability continues decreasing while the current liability increases, because as we go on, as we are nearing the end of the lease. So then that is a trend. All that we expect you to do is again calculate the lease figures for the 3rd year and plot the amounts there. That is it, and that does it for leases. We have covered the 3 parts: the finance lease. The operating finance lease was covered elsewhere in another session. We have covered the operating lease and the sale and leaseback. And I must say, on behalf of RCM Publishers, I'm grateful for your participation. because if you're not watching, you're not participating, we'll not have a purpose for this. But with you, we are encouraged. Lastly, I will encourage everyone to arm yourselves with this. These are study guides and revision guides. For every unit or subject, there is a study guide and revision guide by RCM, prepared by including ourselves. So we have a lot of confidence in this material. We have a confidence in ourselves, we have confidence in our material. So have a look and see what that involves. For that matter, we encourage you to order for these books. We have these contacts. This is for RCM publishers. That is the telephone number for the person who would provide you with the study material, and also would admit you for the e-learning. Then mine. Yes, as you can see, we have nothing to hide. We are open. So the reason for giving you that number is that you can also call and ask more about the tuition program and about the study materials. I'll be at hand to help. But more especially, this person is at hand to help much of the time, and I would recommend that you concentrate more on that number. Thank you very much. Welcome.